Welcome, Jamie. Good evening. I call this August 22nd, 2023 hybrid meeting of the Board of Finance to order. And we will start with approval of the minutes. I move to approve the May 23rd, 2023 Board of Finance meeting minutes. Do I have a second?
Second.
It's been moved and seconded, and since we are all present, we do not need a roll call vote. So all those in favor signify by saying aye.
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 Thank you. Item 3, presentation by Madam Treasurer to present.
Thank you. Good afternoon, Chair Baca and Commissioners. My name is Nancy Burst, and I am the Treasurer of Bernalillo County. We've put up, there's our presentation and our report. And just a reminder, this is for the quarter ending June 30th. And June 30th is also the end of the fiscal year. So you'll be getting some end of the year information as well. I do want to check to see that our GPA advisor is on. Wonderful, thank you. There's our agenda. The agenda has not changed. Then we go to property tax collections. And there's your last, the current year, 2022, that we collected for, and the past 2 years. Remember, this quarter also contains April, May, and June collections. So that's your second half of the 2022 collections. So you'll start to see a difference between that and third quarter that we reviewed for you. So we were charged with $817 million to collect this year. We collected $794 million. So that left uncollected the $23 million that we'll be collecting over the next 3 years. We have up until 3 years to collect property taxes before it's turned over to the state for them to finish collections. There's our collection rates. So on the very bottom for 2022 was 97.17% is what we collected. That's pretty darn good, but it wasn't good enough to make our performance measure. Our performance measure was looking at being 98% 2 years ago because we were down to 96%. So, but each year we've increased. So last year was 97.03%, and then of course this year 97.17%. And you wouldn't think those little percentages would matter, but it does. An extra million here, an extra million there is always helpful. The next slide just gives you your dashboard, your high-level dashboard of operations in our office. You see there our call volume for the quarter was 10,000, almost 11,000 calls. Remember, though, that's because we had the second half. And anytime there's a collection, first half and second half, we get more calls, more questions. And we're glad to answer those. For the fiscal year total, that was 33,000 calls. We are by far in the county the largest call center, if you will, for the county. And that's why we did like the module that we have out of Ring Central. That is like a call center module, that we can take these calls, we can have 6 to 10 to 20 people on the phones taking those calls, and then on the back end, we get all the operational information. So we know who's made how many calls every day, for how many seconds, all that good stuff. We show you the high-level stuff. Just a comparison, 33,000 for this year. Last year we were at 15,829. So we're a little short, because that was just for the quarter, by the way, the last quarter. Looking at delinquent accounts and delinquent collections for the quarter, and hold on to your seat, 25 million. That is pretty darn good. And I'll call on my new delinquent accounts manager to stand up. That's Janessa. There she is. She and her team have been working diligently on this, and you can tell it really shows. Look at that fiscal year total. We have never seen that at 56 million. And that is only delinquent accounts. But it's 10 years worth. But still, it's a wonderful mark, and we love sharing it with you. Payment channels, how the money comes in, we're able to break those out for you. The escrow and mortgage files for the last quarter was 114,000 came in that way, payments. In-person and mail was 2,000. Online was 21,000. And I gave you the quarter three there comparison to see. But that's a lot of payments that are coming in. And we are happy that our new merchant services got point and pay. Are they on their fourth year? Third year? Four, but we implemented in a year, so really it's just 3 that they've been online, taking our online payments. The top right, the delinquent transfer to the state. Remember, at 3 years of being delinquent, if we haven't collected, or even if we have collected, we still, by state law, have to create that list and turn it over to the state for collections. And their collections are a little stiffer than ours in that they can do installment agreements with the person, get them back on the right track financially and in paying down those delinquent accounts. But of course, the flip side is true too. They're the ones that can have the authority to auction property right here in this room for delinquent accounts. So, but we like to keep that changeover to the state low. So for this year, we only turned over 331 properties. And if you look at the graph below, you can see that is the lowest in 7 years that I have listed there. But I went ahead and did some little research, and I went back to 2014 and 14, 15, and 16, and those ran 400, 500, 600. So we'll add, that's the lowest in 10 years, which is a whole tax roll. So we're very proud of that, and couldn't be happier, really, because again, as Commissioner Barboa knows, that means people are staying in their houses. Nobody's getting kicked out. Nobody's going into foreclosure. They're in their homes. We're working with them. Next page is the distribution. And that's how much did we, of our collections that we have that go out to these different taxing entities. And, I lumped them into the education, county, city, health, environment, and state pie chart for you, because I think that's more meaningful. If you do need to know the individual amounts, that's on your appendix, on the state maintenance or our maintenance report. It has all those figures for you, and you can look up APS. You can look up CNM and see how much they received from us for the year. So that's important, I know, when constituents call. And my turn to change it over to Deputy Ryan Travelstad.
Thank you, Madam Treasurer. Madam Chair, members of the board, my name is Ryan Travelstead. I'm the Deputy Treasurer here for Treasurer Burse. I'll go through a quick economic update and then present some of the June 30 ending balances, and then turn this over to GPA, the county's investment advisors, to talk through the strategy that they'd like to continue to employ for the coming quarter. So to get started, jump right in here to the economic update. The Federal Reserve is still continuing to raise interest rates, which is great for the county's investment portfolio. It's also starting to show signs that it's getting inflation under control. There's some signs in the economy that shows that consumer spending is continuing to remain strong. Generally, it looks like the Fed might be piloting the U.S. economy into what they call a soft landing, which means that they're going to raise interest rates to control inflation without bringing the economy into a recession. So time will tell on that one. If I knew the answer to that, I probably wouldn't be standing in front of you today. But yeah, really looking forward to seeing how this shakes out. On the flip side to that, there is a little bit of stress that's showing in the commercial real estate market across the country. And then also the Fitch rating agency downgraded the U.S. debt from AAA to AA+. In our opinion, it's kind of largely symbolic there. I don't think that's going to have an impact on the Treasury to pay off their debt and to make their debt payments. So the county's investments in U.S. Treasuries, we anticipate to receive those funds at maturity. The next slide here is a new slide for this presentation, and it was at the request of Commissioner Olivas, so thank you for making this recommendation. This details the gross receipts tax collections over the last 2 years. So if you can see here that you'll see a steady trend upward. You can see some spikes in between there. If you notice here, the spike here in February, what this is the distributions that the Treasurer's Office receives is from business activity of 2 months prior. So these spikes in February are actually for December business activity, so which would explain the spikes, Black Friday shopping and Christmas shopping and all that good stuff that flows through there. So as you can compare these, you see June 2023, roughly around $23 million of gross receipts tax. June of last year was let me make sure. Yeah, 20,500,000 roughly. So slide that kind of shows that steady increase there on gross receipts tax. And one thing I might point out here too is that this includes all funds. So there's general fund, environmental, ESGRT, behavioral health. So this includes all avenues of gross receipts tax. The next slide here, it's also a little bit altered from the previous versions. So previously we would report out all of the bank accounts and show the associated collateral, but several of our bank accounts are fully FDIC insured. And so from a risk perspective, we figured we would break this down and make it a little bit easier to understand where there's just the accounts and those uninsured balances. So you'll see here the 3 accounts, the Wells Fargo Bernalillo County accounts, Wells Fargo Housing Nonprofit, and then the Bank of America repurchase agreements. Those balances, associated collateral requirements, and then the actual amount of collateral pledged. So again, the way to read this, if we look at the first line, there's $20.4 million of uninsured balances at Wells Fargo. The state statute requires 50% of that balance to be held in collateral. We had a 79% pledged, so that left a $4.2 million shortage there. So what that means is in the worst case event here, if Wells Fargo was to go bankrupt, the county would lose $4.2 million of that funding. So we're comfortable with the 50% that the state requires. Wells Fargo, historically has been kind of one of those too big to fail banks, and so we don't see much risk there in that $4.2 million. The next slide will detail all of the portfolio balances. So we'll start here with the bank account. So at the end of June, we had $5 million of available cash to pay bills. As interest rates have risen, we've started to manage that balance to be a little bit tighter, just because we can earn some interest on that balance. So roughly for every $1 million that we have invested, or that's in the highly liquid bucket versus the bank account, that's roughly around $130 to $140 a day in interest. So we figure if we can manage that bank account balance a little bit tighter, then we can earn a little bit more investment income. The next bucket down is the highly liquid bucket. That's $128 million. That's essentially immediately available. There's some certain intraday cutoff times there that we have access to that. The next bucket down is the liquid bucket, which again, it's we've purchased securities to match known outflows for such as payroll, debt service. So as those outflows are coming due, we have maturities that come in to fund those. The next bucket down is the core bucket at $400 million, and then the bond proceeds bucket at $38 million. And if you'll see here to the right of those balances, The book yield in the very far right column, you can see the highly liquid is earning 4.94%. Core is at 3.27 and bond proceeds at 4.78. The next several slides will detail how those buckets are invested along the maturity structure and in individual investment types. This one here is for the highly liquid. This is for the liquid. And then finally the core detail. And then finally a graphical finally the bond proceeds portfolio. And then finally a graph that kind of shows those maturities across all portfolios. So the reason I like this slide is it tells me what money is coming due to fund bills. So if I start to see that these balances are, $10 million in the first two columns there, I know something is not right. So that means that we're not going to have enough liquidity to pay off bills when they come due. So I think we're more than liquid here with $211 million maturing in the next 30 days and $272 million on top of that matures within 30 days and 1 year. And then finally, the net investment income for the quarter. We ended the June 30th, quarter ending June 30th with $6.8 million in investment income for a fiscal year total of $19.3 million in investment income. And if you compare that to the previous years, this is largely due to the Federal Reserve raising interest rates, small part in due to some of the strategy changes that we've deployed with the help of GPA, the county's investment advisors, and then your continued support of the strategy that they recommend. So yeah, very good. It's really great to see an extra $19 million that come into the county's budget, essentially for what I like to call playing a game, making sure that we have enough money to fund bills, and then if we don't need it, we can move that into an investment portfolio to then earn some investment income. And so the next slide here, I'll transition over to government portfolio advisors. If Rashad or Deanne, are you available?
Yes, we are.
Okay, great. Take it away.
Thank you. Yeah, my name is Rashad Masri. I'm with Government Portfolio Advisors, and Deanne Woodring is on the line with me as well. It's a pleasure to be in front of you all again and take you through the reports. I mean, Ryan left me with a perfect position here as just kind of an introduction to the strategy. We see the eye-popping earnings numbers as we go through this, and it's easy, and there should be a lot of pat on the backs in terms of what the team has been able to do to accomplish that. And really our focus is how do we create the right foundation to take advantage of those opportunities, right? We don't have any control over how the Fed raises interest rates. We don't go chasing certain yield and taking on too much risk. All we do is set foundational components so that we can take advantage of opportunities. And right now there's, basically a lot of gravity and a lot of tailwinds at play here with how high interest rates are. It's an environment that is very easy to get caught in, depending on, if you have the right disciplines in place. And that's what we've been trying to do for the last year or more at this point. And it's just exciting that we're poised to really create enough agility in the portfolios to take advantage of this interest rate environment in a really safe and conservative way for the county. So with that, we'll kind of jump into these consent items to go through the portfolio strategies. And I'm sorry, can you all see the presentation?
Yes, I'm on page 16, Rashad.
Okay, great. Then I will try to follow along because I am unable to see that as well.
If you want, I can speak to some of these slides as well.
There we go. Now I can see the pages there. Perfect. And this is really just a quantitative, look at what I just described. Just looking at quarter over quarter book yield across the portfolio buckets that Ryan just described, and then look at our purchases since April 1st. And what it really shows you is we're turning over the portfolios in a really nice, even cadence, and you'll see that book yield continue to climb as short-term investments really have yields over 5%. Most recently, we did a reinvestment just this month for the county. That was a 3-month treasury bill at a little over 5.4%. So those short-term investments are going to continue to have really attractive yields that we'll want to take advantage of. And as risk managers, we're going to continue to be diversified across those buckets to make sure we're poised for varying interest rate environments, which we'll talk about as we get into the core strategy. We can jump to the next slide. This is a look at our strategic targets as we look across those buckets. So for highly liquid, those current par amounts are for fiscal year end June 30th. These targets remain unchanged. We like where this allocation is between the highly liquid, the liquidity laddered portfolio that's kind of looking to match liabilities out to 12 months and under, and then the operating core, which we're looking to deploy between 0 to 5 years to diversify the portfolio a bit while also remaining really well linked to the liquidity portfolio. So the core is going to remain, the target's going to be around 400 million, the laddered liquidity around 200 million. And if you remember that strategy, we kind of build it up kind of in the fall, winter timeframe as tax receipts roll in, and then we fund liabilities out about 12 months. And so that portfolio will actually be maturing off as we match liabilities going into the October, November timeframe. And then probably the next Board of Finance meeting, we'll have a bit more interesting discussions on the strategic direction for how we rebuild that portfolio. We can jump to the next slide. As we look at the operating portfolio, and this is just the maturity cadence of both the liquidity ladder portfolio, which is the left-hand column there, and the operating core portfolio. These are maturities that are upcoming as we look forward into the next calendar year and towards the next Board of Finance meetings. These maturities, as I mentioned, the liquidity laddered portfolio are matched against known liabilities for payroll and debt service primarily. Those mature into cash to fund those liabilities. And then the operating core, unless given direction by the county that those maturities need to be used to buffer cash, which is exactly what they're there for if needed, they would most likely be reinvested according to the existing approved strategy. We can jump to the next slide. And this is a bit deeper dive into the strategy for just that operating core portfolio. It's really broken down into two things and two levers that drive really the risk management piece and the return of that portfolio. And that's how do you diversify in different asset classes? And then how do you diversify in terms of maturity or duration cadence? So first, looking at the strategic asset allocation, those are divided into agency, treasury, municipal, and supranational allocation. These allocations also remain unchanged from the previous meeting. We think those strategic targets on average, if you look at the portfolio, is going to position it best for kind of long-term incremental growth. And that's 50% in agencies, 30% in treasuries, 5% in municipals, and 10%, it got a little bit small on me there, in supranationals. But we're pretty much on target, a little bit over and underweight as we see kind of dynamics changing in the agency treasury market. But I think we continue to like those strategic targets. As you look at the grid below, that's the duration profile. You can also think of it as the maturity cadence of that portfolio. We do want the duration to target the benchmark of a little over 2 years in just the operating core portfolio, but we like to build that 2-year duration profile across a pretty even split with a weighting towards the front end there on the duration. So you can see the allocation that we have across yearly buckets from 0 to 5 years. We're very much aligned with the benchmark. I think as we look at reinvestments and certainly as we look into the fall, if we have potentially excess capital to deploy into the core, depending on how tax receipts come in and what the portfolio is looking at that time, we'll continue to build and match our allocation in the kind of 2, 3, and even 4 to 5 year space where it makes sense. It's a longer conversation there too, but how we diversify in terms of the duration makes a big difference for maintaining stable earnings if interest rates were to fall at some point. And so we want to make sure the portfolio is not only positioned to take advantage of short-term rates as high as they are right now, which it is doing, but also if we do see a downturn in rates, we want to make sure you have an anchor of interest earnings in the portfolio that's going to be provided from the core here. We can jump to the next slide. Then in the bond proceeds portfolio, these are the maturities that are coming up. The cadence here is really a healthy dialogue with the county on how cash flow needs might change and how scheduling might change with these different projects that these funds are allocated to. So the strategy, so to speak, in these portfolios is to certainly match expected cash flow needs and not go beyond that. We can jump to the next slide. And then as a summary, some people like to hear kind of quite a bit more in terms of changes or whatever it might be. And I love these type of meetings where we've built a foundation where, yes, we're going to tactically respond to markets, but all of that we were able to do within the existing strategy. And so building a foundation to say, let's in a serialized way prioritize safety, liquidity, and return. Let's create these buckets that can, I really like the word, create agility in the portfolios to be able to kind of evaluate what's needed at a given time, whether it's around tax receipts or it's around coming into low periods for the county. So our overall theme here is we want to maintain the existing strategy in the core portfolio, in the bond proceeds, and in the laddered liquidity profile. And that's all from us, but I'm certainly happy to take any questions, or Deanne, if you have any additional comments, feel free to chime in.
I have a quick question. For the duration, that bottom table, I like that we're taking advantage of the rates. It kind of stings a little bit to not be taking more advantage of the short-term rates, which I get we don't want to put all of our eggs in one basket, but if we're going to be going over some of the ranges or some of the targets, could we spread it a little more evenly so there are equal amounts over in each category? That way, like in the 1 to 2 year, we're under target, and those are, better rates than the 4 to 5 year, which we're over target. And just want to see what the possibility of that is trying to evenly spread those overages.
Definitely.
Yeah, good question. Sorry, go ahead.
No, you're good. I was gonna make sure that if you were ready to address that one. Please proceed. Thanks.
No, it's a good question, and certainly that grid is a little bit difficult because it's also a point in time. So that was as of 6:30. I don't have the exact percentages. I think they would be really close to where they were right now. And we can certainly look at kind of evening out that cadence and making sure that you are taking advantage of the short end. So the other thing to keep in mind is you're also really taking advantage of rates under 1 year in those short-term rates in the highly liquid and in the laddered liquidity portfolio.
Sure.
And so that's and as Ryan mentioned as well, in that maturity chart, we're heavily weighted when you look at the total portfolio in under 30 days and in under 1 year maturities, which is absolutely taking advantage of rates that are, into the 5.5s at this point, with where your, earnings rates are on pool or the money market, or certainly securities that we're looking at short term there. So we like that allocation and exposure there. And in terms of the core portfolio, we really want to use this portfolio to position the county for any sort of downturn in interest rates, because part of what we're trying to accomplish in the portfolios is to smooth out earnings or create consistent earnings. And what we don't want to do is drop, have too much leakage in terms of rates. So we're not talking about, 100 basis points off of short-term rates too. I think the securities we just reinvested in the core or something, even out in the 3 to 5 year space are in the 480, even 490 range for what I saw recently. So it's not too far off of those short-term rates, but what we want to be cognizant of is as interest rates turn, those short-term investments are going to go just as fast as when they went up. And so what we don't want to be caught with is too much capital short where we're now deploying it into a lower rate environment. So we want to have a reasonable allocation out into that 3 to 5 year space, so that yes, right now 4.8, 4.9 is a little lower than short-term rates, but you're going to earn that for 3 to 5 years, despite whatever happens to interest rate cycles. And so I think to your point, we absolutely will keep an eye on those allocations, and we can certainly try to even them out where it makes sense. And we don't want to get too overweighted in the long term, to be really clear. So we'll keep an eye on that, look at where that allocation is coming into the fall, and see if we need to smooth that out. But we also want to use the core portfolio to as a risk management technique in case interest rates were to fall.
Sure. I think it's more just the overage, and then changing the allocation to different terms. That's a strategic decision. This is more of a question of if we have some extra funds, are we putting them over goal? Where are we putting them over goal? And I'm just saying it may be worth it to spread it like peanut butter evenly across all the categories if those are strategically the right terms that we want to be, or percentages in each term we want to be looking at.
Perfect. So to put numbers behind it on that grid, yeah, exactly right. If we were going to allocate to the core portfolio, we would look to fill gaps where we are off from that target. And
Yeah.
so if it means upping the allocation into the 1 to 2 bucket because we're underweight there, that's exactly what we would do.
Gotcha.
Right.
Thank you.
And I might add too, in our last finance committee meeting, we discussed that whether we deploy more to the core and try to move that level up. The choice was pretty easy because of what you're noticing, Commissioner, that rates were so high in the front end that just got parked in your liquidity ladder. So you don't really see that in that micro part. Instead of trying to move another 50 out longer, we held that and took advantage of those shorter rates to deploy later on.
Thank you.
Any other
Madam Chair
questions?
and Commissioner, I'll add too that we want to remember our core also contains our reserves, the required reserves from the state, DFA, and then our own Bernalillo County reserves that are required by our own internal policy. So we want to make sure those are there. And I really don't, in my mind, count those. That's because that's rainy day money and it's never going to rain in New Mexico. But
Yesterday.
but I know from the past we were low on the core and on the reserves, so we want to make sure that that is there. We've talked for about 2 years of being over liquid, meaning everything was in this, under 1 year, and COVID and the feds, put us there. It wasn't good to go to the core, but now to have that structured philosophy of investments and doing it the correct way for us, it won't be right for every county, but for us, this is what I think we need to do. And in our investment committee, when we talk about it, GPA is quite aware of making sure that we're not, having holes, missing holes, those kinds of things, because that would not be too good. But that's why we hired them. They're a great company, and they know to look for those things, and they know to tell us. They're always, Ryan and Rashad are always talking, and that's good. Because again, that market can be volatile, right? So we want to talk that through every time and say what's the best decision. So thank you for bringing that up, Commissioner. I know you hear that in our investment committee.
Any other questions?
I just have one question.
Your mic is not on. Madam Vice Chair.
Also about the duration, I believe we moved to the 5th option on that duration table just last year, right?
Yes, ma'am.
So thank you. And that, do we have the 6th and 7th because we're planning on moving into those?
It's a very great question. So it was the policy review last year that was approved to extend that out to the 8-year maximum maturity. Previously, we had that capped at 5 years. And Rashad, I'm not sure if you want to speak to this. I'll give a quick high level of some of the discussions that you and I've had, but essentially the yield that you would gain from investing out to the 8-year, it doesn't really offset the risk. So I think maybe I will speak for GPA, but Rashad, feel free to correct me. But yes, essentially we're gonna invest funds where it makes the most sense, and when opportunities present themselves potentially in that 8-year time frame, then we would take advantage of those. But currently there's not many opportunities.
I remember that now. Thank you for the reminder.
You're welcome.
That's it.
Yeah, and just one comment to add there, that was well said. We like to post that there because that is the policy limit, and it kind of gives you an idea of what your constraints are and then how we're operating within those constraints. So it's just a good visual. And then the other piece is just a kind of fundamental, how do we select a benchmark to evaluate how well that portfolio is performing? And the benchmark that was chosen for the county is also the 0 to 5 year all treasury benchmark. So that's all treasury issuances you can think of between 0 and 5 years. The reason we chose that, in addition to kind of the marginal opportunity that we see beyond, in the 5 to 8 year period, as Ryan just mentioned, is that creates a really nice risk profile for the county to be able to really manage an investment portfolio that is about 2 years on average in duration. And then while we're investing this a little bit longer term, it's also money that's not locked up, and we're really committed to making sure it's linked to your liquidity portfolios. And so we don't want to get too extended beyond that 5 year mark, because then it might create opportunities to get a little stretched in the portfolio where we wouldn't be, kind of getting the return allocation for that risk. And so, the 0 to 5 years makes a lot of sense with the duration profile. It also allows us to be really linked back to the liquidity portfolios if you do need to buffer cash with some of the maturities that come due in the core portfolio for, could be unexpected outflows or even in kind of contractionary periods in the budget.
Thank
Madam
you.
Chair, Commissioner Barboa, excellent question. Thank you for that.
Thank you. Oh, Commissioner Olivas.
Thank you, Madam Chair. I just wanted to thank you all for your thorough presentation and your good work, obviously reflected by the much larger returns, which, you can take credit for, even if you weren't the ones that were raising rates at the national level. But, you're still part of that, and I do support the strategy. I think this makes a lot of sense to have this laddered portfolio that takes advantage of some of those longer term rates, as we don't know what's going to happen if there's a recession or something like that really negatively affects the rate environment. We have some cushion there that'll probably slowly bring us down from those higher returns, but maybe a little bit more slowly than if we're over leveraged in one direction or the other. So I appreciate that diversity there, and thank you for incorporating the GRT piece.
Madam Chair, Commissioner Olivas, thank you. And thank you again for the recommendation. And if any other members have recommendations for data to include in the presentation, I'd love to hear those and incorporate them.
Thanks very much. If there are no further questions, we'll move on to approvals. County Treasurer, investment policy review and approval of changes. Madam Treasurer.
A second.
Do you have a presentation first before, or do we need to move, make a motion for approval?
Not at all.
No presentation? Okay, wonderful.
We were ready for one, but
Okay,
I had one last slide, but we can skip that too if you like.
okay, well, I will.
I
move
I
to-
don't have a watch, so I don't know how I'm running.
We're doing okay, but we have 20 minutes, so.
Okay.
So I do move approval for the changes of the investment policy, and seconded by Vice Chair Barboa. Any questions, discussion?
There we go.
If not, well, all those in favor say aye.
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 None opposed, thank you. Advice and consent, County Treasurer again. I move to give advice and consent to the proposed quarterly investment strategy as outlined in the Board of Finance report. Do I have a second?
Second.
Seconded by Commissioner Casava. All those in favor?
Aye.
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 Okay, thank you very much for your presentation and for your hard work. I now will announce the next Board of Finance meeting will be Tuesday, November 14th, 2023, at 4 p.m. in these chambers. Did you have a comment, Treasurer?
I just wanted to take a minute and introduce you to some new management staff that we have.
Great.
You already heard about Miss Janessa,
Yay.
but we have Robert Dean, who's our cashiering manager. And then we have Mike Gutierrez, who's our new accounting manager. And behind him is Dennis Howard. I always forget when they have two first names. Dennis Howard, he's also in the accounting department. And then we have Michelle. She's in our customer service. And Mr. Sid Duran, who does our special accounts. And let's go back to Stacy. Stacy is our new communications specialist.
Yay.
We also have Dominic, who's also in accounting. Speaking of collateral and things like that, that would be Dominic. And then my other deputy treasurer, Irene Cerna. And next to her is Geraldine. I could introduce you all back there if you're okay.
One more. Yeah.
Okay, all right. So many of them are new managers, so we always whip them into coming to a Board of Finance so they can see what we all do. Or just go into that big room, big scary room, and you have to say, Madam Commissioner, Madam Chair, learn all that protocol. Thank you for your time.
Thank you all, and we're not that scary up here. Thank you,
Thank you for
Madam
being
Chair.
here.
Thank you.
If there's no other business, this meeting is adjourned.